Are we going to see $250 billion worth of mortgages go into pain? Well, today, let's jump in and see what's going on. Starting off on the top, we see veteran banking analyst John Mott saying that even borrowers with full-time jobs might not be able to escape mortgage delinquencies as sharp rate rises collide with huge household debt. That's why they're sort of saying there could be a bunch of mortgage pain on the way. Well, at the moment, we've seen in the last sort of few years, $250 billion worth of mortgages taken out. And they might be at risk of delinquencies as the Reserve Bank continues to increase rates. We're seeing that over the last number of months, a consistent increasing of the cash rate, which is putting a bunch of pressure on borrowers. We're seeing John Mott, who's a banking analyst, saying that even borrowers with full-time jobs might not be immune from mortgage pain and delinquencies. Now, what does that actually look? Well, Mott goes on to say that in previous housing cycles, we've tended to see mortgage borrowers default for a factor of three reasons, really. One is unemployment. The second is family breakdown. And the third is health issues. Well, let's have a quick look at the unemployment rate. We can see that's at an all-time low, seasonally adjusted, we're at 3.5%. So that's certainly not going to be a factor that will affect borrowers at all, given that unemployment is at historical lows. The other factor that he talked about was family breakdown and health issues. I guess they're not really ones that are going to be likely to happen. He talks about unemployment is unlikely to raise from near historic lows. But what Mott does worry about is the speed at which the rates are rising and how quickly household debt has been built up in recent years. Now, that's certainly something that is of concern for a lot of people. What we do know from the Reserve Bank's point of view, they keep an eager eye on a number of factors. And we do know that household consumption make up for about 50% of the gross domestic product. This is one thing that they keep a keen eye on, because if we see 2 quarters of GDP in negative, that means we're actually in a recession. We can see here in this graph here, the factors that make up the GDP and the areas of spend that the Reserve Bank keep an eye on. And as rates continue to go up, we know households look to tighten their belt buckles and start to clamp down on areas in which that aren't so much required, such as travel, discretionary spend, so on and so forth. So we're definitely going to keep a keen eye on the GDP and how that's going, and if Australia is moving into a recessionary format. But what we do know is with the history and the past and what we've seen, what's the striking magnitude of where we're currently positioned is the amount of mortgage growth, what we've seen in the past 2 years. He compared it from the last 10 housing downturns. We've actually had a 70% increase on household commitments in the last 2 years before the current downturn that we're seeing. Now, this is the second biggest jump since lending data first captured these sort of informations from 1970s, and it was only beaten by 131% with the rise leading up to the 1988 and 1989 downturn, which might be before a lot of people watching the video today. So we can see that Mott is concerned about the housing market and I guess where things are at. The Reserve Bank argues that borrowers are in a good position on average, with 70% ahead on their mortgage repayments. What we do know is the banks effectively during the assessment of last couple of years have always added a 2.5% buffer on mortgage commitments. And we know with the cash rate at the moment, having increased from that 0.1% that we saw previously, they're talking that the cash rate could get as high as 3%. So the buffers that the banks used initially, we'd factored in the rate that you could get back then, plus a 2.5% buffer. Effectively, the cash rate that we could get to could mean that the borrowers that were previously assessed a couple of years ago are at their limit from a lending standpoint. But other factors we haven't factored in is increase in incomes, if that's happened. The other detriment is increase in costs for inflation. So definitely interesting times. That's where we have seen some banks even consider, we've seen this in the UK, 50-year mortgage terms, where that really puts a little bit more of an ease on borrowers and their repayment history, particularly with record debt levels. We've seen this previously, where back in the day, mortgage terms were a lot lower terms, and we can see back in the 80s, mortgage terms used to be up to that 25-year terms at the maximum, and we can see how the easing of credit and property growth are very strongly correlated. We can see values of properties and debt to income ratios, where we're currently sitting in around that 6% at a record high. And what we do know is the Reserve Bank, ever eager to prevent any crash in property markets, will look to change regulatory requirements of the banks to ease the assessments. Now, Commonwealth Bank has estimated that up to 10% of borrowers had taken up to their maximum possible mortgage account amount over the last 3 years, and that these borrowers can withstand up to a 2.5% increase on rate rises. And effectively what that means is they won't have any excess cash left over from their monthly budget based on the bank's assessments. Now, it's also estimated that a similarly large or slightly larger portion of borrowers will have gone very close to the maximum loan amount back then when the banks had done their assessments. So definitely interesting to see how that plays out. We obviously have seen in the past housing cycles, we go in that boom bust, and particularly in the last 2 years, we had some incredible growth. That's starting to slow down there. A fair bit of negative news out there. A number of people are worried. It certainly is becoming a bit of a challenge. We see real wage growth over the years. That's certainly something that will be interesting to see play out, because as we see wage growth increase, that should ease some of the burdens on households and the cash rate continuing to increase there. Now, mortgage stress will actually be compounded by the fact that there's also another $800 billion worth of fixed rates that had been taken out in the past 2 years at rock bottom rates. They were actually getting fixed rates back then about that 1.89, 1.99%. We're actually going to start to see them expiring. So borrowers will be facing steep increases in costs on fixed rates. And this is another thing where we have seen a number of banks play out a few different scenarios where they're saying that they see the cash rate peaking next year or at the end of next year, and then potentially where the Reserve Bank may need to rethink their strategy. Inflation gets under control. Market might be in a position where they have to start reversing course of sorts, and the cash rate may actually come down based on what we've seen. Now, the banks do have bad debt provisions. We're seeing they're at historic levels of low. Did see also over COVID, the banks really threw everything at the housing market. The government jumped in where they allowed mortgage pauses indefinitely. We saw the Reserve Bank having a number of quantitative easing measures where they talked about printing money effectively to infinity and beyond, was the saying they were talking about there. That's what the US Fed came out with. So we do know when and if the market does turn, if we do move into a recessionary sort of a terms with the banks, and they're looking at that and seeing what's going on, that we might find the Reserve Bank might have to pull out some of their other levers and slow down on increasing the cash rate. Now, the forecasts for CBA's bad debt charge in terms of their basis points that they put down to this, they're sitting at 2 basis points at the moment for the financial year of 2022. They've increased that quite a lot for 2024, so they've got a provision for bad debts as an example there with CBA. And I guess what summarizes by saying that there's no systemic risk in the banking system. The rising credit impairments are certainly something that can be absorbed and held up by the banking system. And he talks about the fact that it's unquestionably strong regime that's been implemented over the past decades underpins the strength of the bank's balance sheets. Definitely will be interesting to see what happens. What we do know is previously the banks had, when giving borrowers assessments in their situation, taking into account a 2.5% increase. What that means is the official cash rate back then was 0.1 plus 2.5% gets to 2.6%. CommBank actually interestingly said their prediction was that the cash rate would peak at that 2%, 2.6% mark. So I guess there's a lot that's still being played out. We've seen rates continue to increase. Let us know if you have a mortgage and you're wanting to review that and see if you can get the rate down. Call us on 1300 088 065. Did you know here at Hunter Galloway, we help home buyers right across Australia? We're based in Brisbane. If you're living in Sydney, you're in Perth, you're in Adelaide, you're in Melbourne, hit us up. Definitely can assist. There's zero cost for the service. Happy to have a chat. Visit our website, huntergalloway.com.au, and also leave a comment below. We'd love to know what you think. And if you have anything you'd like us to talk about, leave a comment there. Read everyone, and we'll be sure to reply to you. Thanks, guys. We'll see you next time.